Okay, let's go.
This time-lapse shows a chaotic geometric line graph. Right now, it is a fast-paced blur of market noise. But as we apply a few specific rules, that chaos resolves into a clean, sharp, highly simplified structure. This is how you find clarity. In this video, you are going to learn how to mark up a price chart from an absolute blank slate, spot a clear entry, and place a rule-based trade without any guessing. To follow along, open up your charting software. Turn on your paper trading or simulator account so we are using fake money, and pull up a standard instrument. We will use crude oil for this walkthrough. When you remove emotion and replace it with concrete, objective lines on a screen, you stop reacting to what you hope the price will do, and you start executing a repeatable system. Select the ray tool. Anchor point A at the highest or lowest peak, then stretch it to the next major pivot, point B. A price candle can never intersect your trend line. Left cuts straight through, wrong. Right rests cleanly on the edges. If you draw a line and the price pokes through it, even slightly, you have to adjust. Simply grab point B and drag it out to a wider angle until the price is completely clear of the line. Forcing the price to stay entirely on one side of the trend line is what validates the structure and gives you accurate boundaries to work with. If you ignore this rule, you are just drawing random lines. Now we apply those lines using top-down analysis. We start our charting on the highest time frame to get a bird's eye view. Switch your chart to the monthly time frame and draw your first upward and downward trend lines. Once the monthly lines are drawn, step down to the weekly chart, then the daily, down to the 4-hour, and finally the 1-hour chart. We are steadily zooming in on the price action. As you move down time frames, you need to add steeper lines to capture the closer price movements. Your new point A must attach directly to the most recent point B from your higher time frame. All your lines must connect. When you zoom in, the chart expands visually. A line that looked perfect on the weekly chart might be cutting through a wick on the daily chart. Just grab the line and tweak it slightly so it perfectly hugs the candle edges again. Keep connecting and adjusting your lines until you drop into the 5-minute time frame. Stop right there. This is our designated execution zone. By nesting these timeframes, you have funneled months of data into a highly focused area. You now have a precise map showing exactly where the price is currently wedged between your upward and downward boundaries. At this point on the 5-minute chart, your job is to sit on your hands. You do absolutely nothing until the price visibly breaks through one of the lines you just drew. When price finally breaks our boundary, that line becomes our action line, your signal to enter the trade. Meanwhile, the unbroken line opposite the price channel becomes the safety line. This is your defensive shield, telling you exactly where your trade is invalid. Open your order panel and place your trade in the direction of the break. The very next step, before you do anything else, is to set your stop loss. Your stop loss placement has one strict rule. Drag it to the opposite side of your safety line. It cannot sit on the line. It must rest securely on the outside of it. This interface mockup shows a stop loss being placed on a simulated $5,000 account. Take a close look at the dollar value attached to that stop loss. That number should never exceed 2% of your total account capital. In this example, your maximum fee for a losing trade is exactly $100. By placing your stop loss just past the safety line and verifying that dollar amount, you have mathematically capped your worst-case scenario. You know the exact cost of the trade before it even has time to play out. This chart shows the ideal scenario after entry. Your job is just to hold the position. As long as price bounces gently off your safety line and moves in your favor, stay in the trade. But the moment price cuts back through your safety line, your setup is invalidated. Close the trade immediately. No hoping, no holding on. After the trade closes, document it. Open a spreadsheet and log the date, the instrument, your entry price, your exit, and the final result. You have to track your data to see your patterns. Your next step is to get the reps in. Take this exact process, drawing the top-down lines, waiting for the break, setting the safety stop, and logging the result, and repeat it 20 times in your paper trading account. Consistent trading relies entirely on following clear visual parameters. You place lines, wait for a trigger, and protect your capital based on those exact lines. It is strict, it is repetitive, And that is exactly why it works.